Welcome to Do You Ever Wonder with your host, Mike Haltman. It's the podcast that will answer your questions about many of the things in life we've always wanted to know more about. Our guests, experts in their chosen field, will enlighten us about subjects ranging from real estate, business, career, science, philanthropy, and much more. Proudly presented by Hallmark Abstract Service, it is once again time to sit back, relax, and enjoy the ride on our information superhighway. And now, here's Mike Haltman.
Well, hello and welcome. I got to work on that fade out a little bit, but hello and welcome to everyone. Welcome to Do You Ever Wonder? We are the podcast that tries to answer the questions that people have questions about, and it can run the gamut from, as we said in the intro, business to philanthropy, health, wellness, a lot of different things. But my name is Mike Haltman. I am the CEO of Hallmark Abstract Service, and today I will be your host. So we're going to talk about a very interesting subject today. We all just got over yesterday, which was tax day 2022, and we're not used to the IRS ever really bringing us anything of any value or really bringing us anything other than agita. But there are cases where, in fact, the IRS does bring gifts of a certain type, and that's what we're going to discuss today. So if you're an investor of real estate investment property, then you have the opportunity to really partake in the gifts that the IRS is giving, and that's in the form of what's known as a 1031 exchange. So today's guest is an expert in the field. His actual name is Rob Pecha. He's also known as 1031 Rob. And he's also known as the quarterback of the 1031 exchange. Is that right?
You're a 1031 exchange quarterback.
You know what? I almost had it. But in any event, welcome, Rob.
Thank you, Michael, for having me.
Absolutely. Absolutely. So, can you just talk a little bit about, since I know you work in a little different area of the 1031 exchange than what most people think about, but can you talk a little bit about the 1031 exchange? What exactly is it?
Sure. So just to kind of backpedal and speak to your point, Michael, 1921, so 100 years ago, the IRS gave us a little gift. And contrary to what most people would think, it was actually a pleasant gift instead of an unpleasant surprise or a set of surprises. Basically, the IRS said, if you go to sell a piece of investment property and you roll those proceeds into something else held for investment purposes, in other words, like kind, and like kind is pretty broad of a definition today. Uncle Sam says, I'm not going to hit you with the capital gains tax. I'm going to let you defer that into the future. And by doing so, you keep a big chunk of money in your pocket working for you instead of losing a huge chunk in tax to Uncle Sam otherwise. So everybody loves it. It's a great tool. Like I said, it's been around for 100 years. It actually started in 1921 with horses and land. It started as a means for farmers to swap those two things and keep money in the system and generate jobs. And of course, as I mentioned, that definition has expanded quite significantly. Today, like kind is considered all types of things: duplex, triplex, triple net, and ground lease, air rights, mineral rights, triple net leases, TICs, DSTs, all types of stuff. So there's a lot of stuff to choose from. There's a lot of misconceptions out there in terms of, okay, I sell a brownstone, so I guess like kind means I have to roll into another brownstone. It's not exactly like that. The litmus test is it has to be held for investment purposes. That's the main thing. And me, in terms of what I do in the context of a 1031, with a moniker like 1031 Rob, I like to jokingly start with what I'm not. And people frequently think I'm a real estate attorney. I'm not. Sometimes they think I'm a CPA. I'm not. Sometimes they think I'm a commercial broker or a residential broker. I'm actually not a licensed real estate broker at all. And I'm not even this thing called a qualified intermediary that, of course, you need inside of a 1031 exchange to custody the funds in escrow and tell them where to go. It's a necessary party and a rule to a 1031, not a qualified intermediary either. So people say, Rob, what the heck are you? Why are you here? Why are you talking to me about my 1031? I'm basically the guy with a modular basket of approved 1031 products that come in all shapes and sizes. So at the end of the day, I'm the guy with a menu of these 1031 exchange ready products come in all shapes and sizes. So we have retail, multifamily, student housing, industrial, self-storage, office, all different types. They're all over the country, but at the end of the day, they're institutional grade properties that pay investors passive income for no headaches and no managerial responsibilities. I'm not for every exchange out there. I do all the hand holding in the world, which is why I call myself your 1031 exchange quarterback. And I say that because I make sure people understand at the very least the basic rules of 1031 exchanges, the timelines involved, the necessary parties that you should have in your corner, like a qualified intermediary, like a great verse CPA and a real estate attorney. So I make sure I set people up for success so that they go into this with the best chance of getting the most value out of it. And I sort of stand by at the ready with this modular basket of products. So I have people that are all in with me and I'm an all-encompassing solution. I have people that use me just for some residuals on the back end or just to infuse certainty in the transaction, because I always say, Michael, just keeping in mind what I do in the context of a 1031, it's going to allow those clients to navigate the exchange more confidently because they have more options. That's that simple.
Well, you kind of took what was going to be the second half of my discussion and kind of shoved it into the first half, but that's okay. I actually wanted to get a little bit into the weeds, not in terms of the 1031 product per se, but if I bought a property for $1 million and it's now worth $2 million, so I have $1 million capital gain. If I roll that into a 1031 exchange and whatever the format of my 1031 exchange is, I'm basically deferring the $1 million that I need to pay capital gains tax on to some point in the future.
Correct.
So now if I buy another property or whatever form it takes, and I invest the $2 million and my $2 million grows to $4 million, at the end of the day, when I sell that second property, am I now paying capital gains tax on a $3 million gain? The $2 million from the second investment and the $1 million from the first investment?
Great question. So potentially, and the answer is yes, if that's what you decide to do. Remember, this is tax deferral. So you're kicking the can down the line. And we say in the business, I know it sounds a little corny, but they say kick the can till you kick the can. That is the only way to effectively kill the tax. Unfortunately, the investor can't realize that benefit in his or her lifetime, but the heirs still get that stepped up in cost basis. So that would eliminate the tax.
Okay, that's great. So it's the same as, so, you talked about like-kind investing. I know that when I was a bond analyst many years ago and a bond trader. And then when you did tax loss swaps, which was a technique of killing a capital gain, you had to invest whatever it was you sold into a like-kind bond. And that meant that it really had to be somewhat of a like kind, it had to be somewhat similar. But with a 1031 exchange, really all bets are off. You can sell a piece of land and buy a multifamily. It's all good.
It's pretty broad. I mean, as I went through that list before, there are a lot of things that are considered like kind these days as compared to 1921 when it was first created. There are certain things that are disallowed, of course, like you can't use primary residence to satisfy a 1031. You can't do fix and flips. Those are things that are disallowed. Things like REITs, real estate investment trusts. People frequently think that's what I'm talking about when I start going down the path of what my specialty is. You can't actually buy real estate investment trusts to satisfy a 1031. So there is a list of things that do not qualify, but the list of things that do is quite broad.
Right, which is great. And I would imagine that these days, the less difficult part is selling a piece of property, especially in New York City, for some kind of a profit. I imagine that the more difficult part of the transaction is the 45-day period where you have to identify a replacement property.
Exactly. So I'm seeing a lot of that now, and I'm actually glad that you brought that up. I would say 97% of my clients, Michael, fall into the category of they bought this property 25, 30 years ago. They bought it for next to nothing. Now they're looking to sell. So they're probably looking at a big capital gains tax. Probably also depreciation recapture, which is often in there and nobody seems to talk about it, but it's a factor. So the 1031 is attractive because if they don't do a 1031, they're probably going to pay quite a bit of money to Uncle Sam, which he will love, but the investor will not. And yeah, they're getting great offers right now. I'm noticing a lot of sellers that are getting like through the roof offers. Problem with a 1031, in addition to that 45 days that you have to identify after you sell to basically give indications of interest on what you'd like to roll the proceeds into, 45 days is not a lot of time. I see people procrastinate. I see them put a lot of all their eggs in one basket. and it can jeopardize your exchange of derailing outright. Additionally, what I'm seeing now is, it's a seller's market. So they're getting great offers on their property. Now, all of a sudden, they're on the other side of the coin and they're sitting in the buyer's seat. So what do you get? Where do you get a
I
good
don't
bid?
like residential.
Right. So that's kind of an area where I step in addition to the 45-day time crunch, which, as investors are getting close to the end, I advocate, let's take a look at what I have, what might make sense either as a backup position or to save your exchange outright. It's also a great way to get institutional grade properties, preserve that value, and kind of kick the can down the line, at which point you get the same options, down the line when these programs liquidate as you have today. You could pay the tax, do no 1031. You could do a traditional 1031 where you find your own stuff in 45 days, or you could roll into these programs again, or anything else for that matter that's considered like kind exchange. It gives the investors options in an environment where it's a seller's market and maybe the buying options are not so attractive.
So I know that Senator Mike Lee, he proposed the 1031 Exchange Improvement Act that was going to take that 45 days because of the lack of inventory and extend it. And I'm wondering, because I haven't been able to find the answer, is that still on the, is that still being bandied about in the Senate, or is that a dead deal?
I've not heard anything about extending the 45-day or 180-day since the pandemic hit. So in 2020, there was a rule that said if either your 45 or your 180-day, if either one of those fell in the window of April 1st to July 14th of 2020, you automatically got a bump to July 15th. So if either one of those windows, and by the way, they run concurrently, if either one fell within that time frame, you automatically went to the middle of July. That's long come and gone, and there's no talk about extending them.
So now I know people who owned, to your example, they owned property, family property that became worth a ton of money and didn't really explore the 1031 exchange for whatever reasons. I mean, do you find that people who are a little less maybe sophisticated or are afraid of the product, what do you find in percentage terms? How many people run right for it, and how many people kind of shy away from it and have to be really handheld and explained and walked through the process?
I wouldn't be able to pinpoint exact percentages, Michael, but I would say that one thing that always surprises me is the lack of planning that goes into these things. When we're talking about what would arguably be a lot of money, and arguably, a lot of money could mean a different number to different people, but I see multi-million-dollar transactions where people they want to sell, get top dollar, but what's your plan for that money? And then you enter this 45-day time crunch and you're running around, or maybe you just procrastinate, or you put all your faith in your broker that he or she is going to find you something in time. And that becomes increasingly difficult to do as you start to get close to the deadline. It's just, I find the lack of planning sometimes that goes into these things is kind of mind-boggling. I'm an ex-military guy. I like to get in front of things as early as possible. So I always advocate, do your homework early, line up your professionals, and know what your options are going well into this.
Oh, no question. So the 45-day ID period, I imagine that the IRS is not, if you come in at 46, 47, 48, they're like, no, don't worry about it. It's all good.
Yeah, don't sweat it. It's cool. No,
it's a drop dead date.
It's a drop dead date. Yeah. And people don't understand that that's a drop dead date. And the IRS does not care if that falls on a Saturday or a Sunday, a religious holiday, or a long weekend. That is 45 days, hard and fast. So calculators for this, when you sell, clock starts ticking. When that hits at midnight, if you do not have your identified choices, and again, those are indications of interest. You don't have to actually close on those, but you cannot close on something and satisfy the exchange that's not identified on that form.
So do most people start to identify prior to closing?
Ideally, I mean, it's real estate, so it moves quickly on both sides, right? The buy and the sell, but you try to get ahead of it. You try to sort of line up what choices might make sense. But I always advocate, don't sit on it. Don't procrastinate, and certainly don't put all your eggs in one basket, because as I've seen in this specialty, and I've been at this for over a decade now, all kinds of things happen in real estate. I've seen the sure thing fall apart, and I've seen the long shot come through.
So if you identify, I mean, here's the quandary with real estate today. If you find a property, you identify it, you go to contract on it, and now you're locked into it, and now anything can happen along the way to 180 days.
Yeah. So in my experience with the 1031s derailing, it's not so much about the 180 close that's as problematic as the 45. And again, the 45-day window is problematic, not only because it's the shorter of the two, but because people procrastinate or put all their eggs in one basket. So I see people do it all the time. They fall in love with one property, and not to get too technical, but when you're identifying, the most common rule is something called the rule of three, and it says you can always name 3 properties irrespective of value. So I tell clients, if you're getting close to the end of that 45-day, if you have your eye on one thing, maybe use those 2 slots to name a backup or 2 with me. I've seen people do it. I've literally been a backup to a backup. I've had people tell me to my face, Rob, you're not my first choice. You're not even my second choice. But compared to paying 40% cap gains, this is a win. So sometimes clients do get backed into it. It's all about having the knowledge at your fingertips and the right professionals to advise you accordingly.
So I guess now is as good a time as any to get into what it is that you focus on more, which are the Delaware Depository Trusts.
Delaware Statutory Trusts. I rarely use the acronym, and I rarely use the actual word itself or product itself because it's easily forgettable. Try to focus on what it does well, and I basically boil that down into 4 buckets.
Which are?
Here we go. So
don't leave me hanging, Rob.
Well, we did give a spoiler alert, so I'm still letting people marinate in that. But yeah, just to backpedal here, I focus on Delaware Statutory Trust. So I'm with an alternative broker dealer out of Chicago called Great Point Capital Advisors, and I have access to a modular basket of these DSTs. So I have a laundry list. I whittle that down based on quality, so I have an even shorter list of recommendations. But I go with sponsors that have the best track records, have weathered the tough storms, have conservative underwriting. These are all things I like. What are DSTs good at? Well, I like to keep it simple. As an ex-aeronautical engineering major guy at the United States Air Force Academy, I love simplicity. I really do. So I try to keep it very simple. What are DSTs good at? Well, the first one I kind of already gave you, bucket 1. I call it the tenants, toilets, and trash. It's the older folks who picked up these properties for next to nothing. Now they're looking to sell, so the capital gains is high, the depreciation recapture is high. Chances are the CPA or the real estate attorney is saying, do the 1031, keep that more of that money working for you instead of losing a big chunk in tax. But a lot of them are not wild about making the lateral move into somebody else's headaches. They knew what it was for the last 25, 30 years, managing that property, dealing with the tenants, the toilets, and the trash. They're not wild about picking up somebody else's headaches again, whether they had a good run or not. They're looking for the income. That's important. They don't want to pay the tax, but they don't want the managerial responsibilities. This is a great way to get institutional grade properties that are professionally run and managed. No headaches, no responsibilities from an investor standpoint. They're literally just collecting that mailbox money every month, waiting for these programs to end, which is approximately 5.5 years down the line, at which point, hopefully they're getting their initial investment back plus their share of the back end appreciation. So there's sort of a 2-pronged benefit. You have a paid to wait number here, which is your monthly dividend or coupon, whatever you want to call it. And then on the back end, you're getting that initial investment back plus your share of the appreciation. So the money grew, then you go back to square one. You do it all over again.
So that's question for you. You have properties that you've identified. Now, let's say it's a $10 million property. Has that property already been purchased and put into a trust, at which point any number of investors can come in and invest into a piece of that trust?
You're correct. So these are already acquired properties, and depending on the size of the offering, it could be a $25 million raise, it could be a $200 million raise, but these are pre-acquired properties already run by professional property management companies, sponsors like Inland, who are great at what they do, and they're running the show. They're running the day in and day out operations. They're professional property management companies by trade, and that's all they really want to do. The investors are fractionally investing in this. So they have fractional ownership interest. They're sitting in a pool of other investors, and everybody's collecting their share of the rent roll.
So if I sold my building for $2 million and this trust has a value or an investable value of $10 million, if I came to you and you recommended this property, I lose the 45-day risk and I pretty much lose the 180-day risk because that investment is available to me.
Correct. These are 1031 exchange ready programs ready to go. I have all the due diligence baked in. They're ready to go. They have no closing risk. You're not going to find any weird third-party environmental reports down the line. So these are ready to go. I will not say it's a fail-safe though. It pretty much eliminates you from the 180-day close risk, but the 45-day ID risk, it's a timing issue. It depends. So if clients are going to use me as a backup, I say be conscious of how long these offerings were out because they have a certain shelf life, typically about 45 to 60 days, somewhere around there, depending on the size. So they will not stick around forever. They'll have investors come in and fill those seats. So as you get closer to the end, if people are going to use me as a backup, And I'd say, let me give you something with a little more shelf life that has been around for a while, but they will not last forever.
So here's another question. If I'm selling a property and buying a property, there are certain costs involved. One of them is going to be the broker, all of the taxes that I'm going to incur on the sale, on the closing. What are the costs involved and how do they compare if I go into a statutory trust?
Sure. So in a Delaware Statutory Trust, all of the fees are baked into the cash on cash number I give. So for example, I say we just had a great self-storage program that was paying 3.75 cash on cash. That's a net number to the client. That means all fees are factored in. Commissions, legal, acquisition fees, disposition fees, property management fees, it's all factored in, but the number that I'm quoting in terms of that cash on cash is net to the client. So the real answer is yes, it's typically higher, but they factored in all of those expenses, and the number that the client is getting quoted is net. In other words, if an investor invests $1 million, their full million goes to work. It's not like that gets wound down to 9 something.
Now, I was reading about why some people will do a 1031 exchange, and one has to do with depreciation. That you're going to lose the depreciation that you've taken over the years has lowered your cost basis, I believe, and now your capital gain is going to be that much more. So explain that a little bit.
Right, so that's where depreciation recapture comes in. They've used up the living daylights out of their depreciation schedule, and now Uncle Sam comes looking for that. It's the reason why we'll see people come out of all cash deals. So in other words, they sell an investment property that's not encumbered by any debt. They didn't retire a mortgage, it's all cash. They don't need the leverage because, as you know, inside of a 1031, always 2 components to keep your eye on. One is easy, it's equity, how much money you cash out with sitting in the QI to deploy. So that's your deployable. You want to deploy every last penny ideally. The other is the LTV component. So if you retired a mortgage, what position is that? It's always something you have to keep in mind, because if you fall short on either, Uncle Sam hits you for the boot or the differential. Now on the mortgage, a lot of times people will come out of all cash deals where they don't need that LTV component. And frequently my DSTs do have in the 40s to 50% LTV baked in at the sponsor level, underwritten at the sponsor level. So they don't actually need that LTV, but the presence of an added depreciation schedule will allow their CPA or tax professional to offset that income. I can't give tax or legal advice. That's as far as I can speak to it, but I can tell you people do it.
Well, you know what, neither can I, but
Yeah.
that's a whole nother issue. So I know in New York City, the office market is a little tenuous right now. I think the multifamily market is great. The industrial market is great. And I don't know if you get involved in this part of the prognostication of where we go in the future, but do you have any thoughts about where we go in the future? There's the work at home versus the commuting, the back to the office. What do you see for the commercial real estate market?
So certain asset classes did very well during the pandemic and continue to. Well-placed multifamily, self-storage, and industrial. Those have fared very well and continue to do so. So there's a strong appetite for those. Retail I personally like, particularly ones tethered to essential grocery. I know during the pandemic, whether we masked up or not, or there were limitations or not, still bumping into people were still buying their groceries. There's still a need for that. There's still a strong demand. Hotel, obviously hospitality, that took a hit. The conversation I was having pre-COVID versus during COVID, quite different, but there is an opportunity for growth there as well. Office, I'm not seeing a lot of growth there. I mean, I'm sure there is. I know there's a demand for people to get back to the norm and have sort of that hybrid structure. But me personally, as a WeWork user, I bounce around to different locations. There may be at like 35%, 30, something like that. It's very low. So there's not a lot of occupancy there. I don't know if that speaks to the office market as a whole throughout the city, but I'm sure it's somewhat of an indicator. But that's what I've been seeing. But back to what I was saying in terms of where the consumer appetite is, retail, tethered to a grocery, or industrial, multifamily, self-storage.
Right. Interesting. I know that malls are a huge unknown. I live on Long Island, and it's I know from the office standpoint, people who got used to not having to get on the Long Island Railroad kind of like not having to get on the Long Island Railroad. And it's you walk around malls and they're pretty empty. So reinventing, repurposing, reimagining. I think that's a big word now. I think that's going to be the way of the future. But for 1031 exchanges, you don't have any problem. The product is there. if you are looking for it.
Exactly. These are readily available. I mean, from the standpoint of COVID hitting or not hitting, I mean, there's still been a strong investor appetite. It slowed down a little bit in 2020 because there were these extensions and a lot of unknowns. But I will tell you, there's a strong investor appetite out there to get things done. I don't know if the catalyst was sort of things being shelved for a long time, or there's talk around the legislation and then neutering or getting rid of 1031s altogether. But for whatever reason, people want to get things done. They want to get back out there. They don't necessarily want to meet. You know, people embrace the virtual, but they do want to get things done either over the phone or over Zoom or just over email.
Well, that was going to be one of my next questions. You're good at usurping my questions, but
Got you up here.
it must be like a Vulcan mind meld, but which is before your time, Star Trek. But legislation risk. You know, the federal government is bleeding cash and needs to try and raise money anywhere possible. And I know that they do look at the low-hanging fruit to try and raise money. Low-hanging fruit meaning a lower constituency base. You know, hurting commercial real estate owners is not necessarily going to cost them a whole lot of votes. So I know that they tried that with one of their pieces of legislation, and it didn't go through. But you know, what do you think? What do you see for the future? Is it going to be back on the table at some point?
Yeah, so great question. And there was a point last year, Michael, where I was getting at least one phone call every day. People asking me exactly that. You know, what's going on with this 1031? Are they going to change it? Are they going to kill it off? Sometimes from people that don't even know what a 1031 is, but they heard it in the news. Again, there's talk of changing it or limiting it to a certain number per transaction. Like a broken record, I've been telling people the same thing. You know, keep in mind the 1031's been around for 100 years now. Started in 1921, and it's been targeted multiple times. You know, it's been on the chopping block before. It's kind of never actually happened. But you think about, there's good reason for that. There's a reason why it has not passed and it has survived the test of time. It creates a lot of jobs and keeps money in motion. The last figure I heard last year, and I'm sure there are updated stats on this, but 1031s create 55.3 billion of revenue, 27.5 of which is labor's money. That's a huge number. By the way, that's not just DSTs, that's 1031 as a whole throughout the country. That's a big number. So I get that they're trying to free up money, and you know, they're scrambling to look everywhere and in every nook and cranny to try to find it. But keep in mind that also this is less than 1% of the overall budget. And to cut off your nose to spite your face doesn't make a whole lot of sense. And you know, contrary to the rap that 1031s get, you know, the popular rhetoric is it's a tax loophole for the rich, or it's only exclusively used by the rich. It's not. A ton of mom and pops, you know, that have generational wealth that they built throughout centuries use this tax code to their advantage, and their families need it. It's not like they're, you know, throwing millions left and right. It's a tremendously powerful tax tool for both the wealthy and not so wealthy.
So now, one of the last things we're going to talk about right now, because I've seen people hurt in a big way, talk about the importance of, however it is that you pursue a 1031, talk about the importance of a strong, reliable, time-tested intermediary. Because I've heard horror stories, and I think people should try and avoid those.
Absolutely. And you bring up a really good point. So qualified intermediary, just to backpedal again, it's a necessary party to a 1031. It's not my rule, it's the IRS's rule. The IRS says you need a qualified intermediary or exchange accommodator or QI, it's all the same thing, to custody the funds in escrow. Fortunately, I've gotten a lot of phone calls where people say, I sold 2 weeks ago, I got the money sitting in my Chase account, 1031, let's go. Unfortunately, you can't. If you did not hire a QI prior to closing to custody those funds, the game is over. Now, with regard to QIs, there's also no regulation in the space. It's as simple as I can take a fold-out table out to the street here, which I'm in Staten Island today, write QI on a tablecloth, drape it over, and I'm in business. It's that simple. There's no regulation. So you want to make sure that you're dealing with entities that are nationally recognized, that are bonded, that have a great track record, hopefully that have somebody with a CES or certified exchange specialist designation on staff. These are all important things that you may want to consider in addition to price. Price-wise, they're all about the same. If you do a forward exchange as opposed to a reverse exchange, they're all going to run you between $800 to $2,000, somewhere in that range. But don't lead with price. That's what I always say. Lead by service and above all quality, because they're not all created equal. Some of them do shady stuff. The more reputable ones will not. So you want to make sure you have something.
The bottom line is, if you put your money with a fraudulent intermediary and the money's gone, it's gone. And that would be a tragedy. So like you said, don't skimp $500 for the guy with the table outside of his apartment. Go to a really strong, vetted, recommended, qualified intermediary.
That's right.
And finally, to close out today, you mentioned that you went to the Air Force Academy. I had the pleasure, I work with a combat veterans charity, but I had the pleasure of visiting the Air Force Academy. And actually we were pulling in, my wife was sleeping, and she woke up when they were asking for identification, and she thought we were going to the zoo. So she woke up and there's a guy taking identification with a automatic rifle in his hands. And she was kind of wondering what the hell we were doing there, but the place was beautiful.
It is. You don't really notice the first year with your face in the dirt, but it is.
Right. Oh, no question. And you know what? I give you a lot of credit.
Thank you.
But in any event, Rob Pecha, 1031 Rob, you can find him at 1031rob.com. And, Rob knows the 1031 industry, and he's another option for someone who has a piece of commercial real estate, wants to enter into a 1031 exchange, and hopefully the information that was gathered today will be helpful for people. But I very much appreciate you coming on.
Michael, I appreciate the opportunity. Thank you for the audience.
Absolutely. Absolutely.
Thanks for listening to Do You Ever Wonder? And if there's a subject that's always been on your mind, let us know. We hope you'll join us next time for the show that answers your questions. And please like and share this episode with your friends and on your social media. See you next time.